Intro. Welcome to Candy Mentor. Today, let's decode why the golden rules of accounting, despite their simplicity, still trip up so many. Accounting is the backbone of business decisions, yet confusion persists. By the end of this video, you'll grasp the golden rules and understand common misconceptions that lead to errors. Let's dive in and unravel these fundamentals. Understanding the golden rules. The golden rules of accounting form the bedrock of double-entry bookkeeping. They guide how transactions are recorded in financial statements. These rules are simple. Debit what comes in, credit what goes out. Debit the receiver, credit the giver. And debit expenses and losses, credit incomes and gains. Yet their application can be complex. Rule 1. Debit what comes in. This rule applies to real accounts like assets. When a business receives an asset, it must be debited. This increases the asset's value in the books. For example, when you purchase office equipment, you debit the equipment account. This reflects its arrival on the balance sheet. Rule 2. Credit what goes out. Conversely, when an asset leaves the business, it is credited. This decreases its value. Suppose you sell that office equipment. You credit the equipment account. The credit reflects the asset's departure, balancing the books. Rule 3. Debit the receiver. In personal accounts, the receiver of goods or services is debited. This rule captures the flow of value. For instance, if you pay a supplier, the supplier's account is debited to acknowledge receipt of payment. Rule 4. Credit the giver. When someone provides goods or services, their account is credited. This recognizes the outflow of value. Paying that supplier credits your bank account, reducing its balance. This practice ensures transparency in transactions. Rule 5. Debit expenses and losses. Expenses and losses reduce equity, so they are debited. When your business incurs an expense, such as rent, the rent expense account is debited. This aligns expenses with the period they occur, following the matching principle. Rule 6. Credit incomes and gains. Incomes and gains increase equity, thus they are credited. When your business earns revenue from sales, the sales account is credited. This boosts the income statement, reflecting the financial health of your business accurately. Common misunderstanding. Terminology. Many errors arise from misunderstanding the terminology. Debit and credit can be confusing because they don't mean increase and decrease universally. Their impact depends on the type of account involved, leading to frequent misapplications. Misclassification of accounts. Another common pitfall is misclassifying accounts. It's crucial to distinguish between personal, real, and nominal accounts. Misclassification disrupts the flow of transactions, causing imbalance in the financial statements. Overlooking context. The context of transactions often gets overlooked. Applying the golden rules requires understanding the nature of each transaction. Context dictates whether an account should be debited or credited, ensuring accuracy in financial records. Technological missteps. With digital accounting systems, reliance on software can lead to errors. Automated processes may misapply rules if set up incorrectly. Understanding the principles behind the software ensures accurate data entry and reduces reliance on defaults. Lack of accounting knowledge. A fundamental lack of accounting knowledge is another reason people get these rules wrong. Without a solid grasp of basic principles, it's challenging to apply the golden rules accurately. Continuous learning and training are essential. Inconsistent application. Inconsistency in applying the golden rules can lead to discrepancies. Each transaction should be treated according to its nature. Consistent application ensures the financial statements are reliable and comprehensible. Pressure and time constraints. Under pressure, mistakes happen. Time constraints in financial reporting can lead to hasty entries and errors. Allocating adequate time for recording transactions is crucial to avoid mistakes and ensure accuracy. Ignoring reconciliations. Regular reconciliations are vital. They catch errors and discrepancies early on. Ignoring reconciliations allows mistakes to compound over time, affecting the integrity of financial statements and decision-making. Continuous learning and adaptation. The accounting landscape evolves, and staying updated is crucial. New regulations or practices can impact how the golden rules apply. Continuous learning ensures that professionals remain competent and capable of accurate application. Outro. If you found this helpful, don't forget to like, subscribe, and hit the bell icon for more insights from Candy Mentor. Drop your questions in the comments, and let's master accounting standards together.